Usually when we look at a massive, incomprehensible fortune, I mean, we're talking like $145 billion here, there is this expectation of cold, hard precision,
Right,
right?
absolutely, yeah.
Like, you look at that final number and you just assume that the person who built it is a machine,
Yeah.
a human supercomputer who just calculates algorithms, strips away all emotion, and, just executes the math.
Right, because it's comforting to think it's just a mathematical equation we haven't learned yet.
Exactly.
We really want to believe that wealth on that scale is binary. Like
Yeah.
it's the product of a secret formula. Buy low, sell high, rinse, repeat.
But then you step into the world of Warren Buffett, and that clean mathematical illusion completely shatters. And that's what we're doing today. We aren't here to just list his annualized financial returns or, read a dry table of contents from a corporate 10K.
That would be incredibly boring.
It really would be. Instead, we are embarking on a deep dive into the human behind the money. We're going to unpack the psychology, the surprisingly dark nights of the soul, and the bizarre eccentricities that actually fuel the Oracle of Omaha.
If we connect this to the bigger picture, Buffett's story is really a case study in human psychology and unbreakable discipline, because when you analyze the mechanics of how he built this wealth, it defies almost every convention of modern Wall Street.
It really does. It's a complete psychological labyrinth. And the deeper you go, the more you realize that his ultimate advantage wasn't a complex algorithmic model at all.
No, not at all. It was behavioral.
Right. And to explore this, we've got a massive stack of sources on the table today. We're pulling heavily from Alice Schroeder's definitive biography, The Snowball, plus decades of these incredibly candid Berkshire Hathaway shareholder letters, Harvard Business School case studies, and various documentary transcripts.
It's a mountain of material, for sure.
It really is. And rather than just reading down a list of his greatest hits, I want us to look at the raw ingredients. Actually, before we even touch the finance stuff, we have to talk about the political and philosophical environment he grew up in.
Yeah, that's crucial.
Our sources dig into his father's staunchly conservative, anti-government background, as well as Warren's own political affiliations later in life. And, just as a framing note for you listening, we aren't here to debate those politics or take any sides. We're looking at them purely as the psychological bedrock that formed his aversion to herd thinking.
And that's really the only way to analyze it objectively. As guides here, we take no sides. We're simply reporting the facts to understand the environment that forged his mindset.
Right.
You really can't grasp why he thinks the way he does without understanding Howard Holman Buffett, his father. So Howard was a stockbroker in Omaha, but more significantly, he was a 4-term Republican congressman.
4 terms, wow.
Yeah. And Howard was a man of intense, uncompromising ideological purity. He was a staunch libertarian, a fierce champion of the gold standard, and he harbored this profound fear of government overreach and domestic propaganda.
The sources actually highlight this incredible moment in 1947 when Congressman Howard Buffett was fighting aggressively against the Voice of America broadcasting domestically. He was, terrified of the State Department using tax dollars to propagandize the American people.
He demanded radical transparency.
He really did. There's even a detail in the sources where he refused a congressional pay raise because he had been elected at a lower salary, and he actually returned a portion of his pay to the Treasury.
Which is astonishing behavior for a politician.
Unheard of.
Right. But consider what witnessing that does to a young Warren. It established a moral baseline that prioritized internal consistency over external approval. Howard taught Warren what is arguably the core operating system of his entire life, which is this concept of the inner scorecard.
Okay, let's unpack this. The inner scorecard. I've read about this, but break down the actual nuts and bolts of it. How does it work in practice?
So it's basically an evaluation matrix. Howard taught his son that you must judge yourself entirely by your own internal standards, not by external validation.
Like not caring what the neighbors think.
Exactly. Warren often explains it by asking this hypothetical question. Would you rather be the world's greatest lover, but have everyone in the world think you're the world's worst lover?
Oh, wow.
Or would you rather be the world's worst lover, but have everyone think you're the world's greatest lover?
That cuts right to the bone. Are you living for the applause, or are you living for the reality of your own actions?
Exactly. Now, transpose that onto a field like finance, which is entirely driven by herd mentality.
Oh, Wall Street is just a pendulum swinging between euphoria and panic.
It's all mostly driven by keeping up with the Joneses. If everyone is buying internet stocks in 1999, the pressure to conform is immense. An inner scorecard is the ultimate psychological armor.
But you just don't care.
Right. You simply do not care if the crowd thinks you're an outdated fool as long as your own math checks out.
But I want to push back on this a little bit because it sounds great in a biography, right? But how does an ideology of human liberty and an inner scorecard translate to an 11-year-old kid?
That's a fair question.
Because, I mean, it's one thing to have a philosophical dad. It's another to practically apply that to becoming a billionaire. Most kids would just roll their eyes at their dad's lecture.
Sure they would. But Warren didn't just absorb the philosophy, he weaponized it into commerce almost instantly. His childhood wasn't a normal childhood. It was basically a laboratory for testing business margins.
Right, the hustle.
The relentless hustle. At age 6, he is buying 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents.
Just a quarter for 6 bottles.
Yeah. And then he goes door to door in his neighborhood in the evenings, selling the individual bottles for a nickel each.
Right, so he's spending 25 cents to make 30 cents. That's a 20% return on investment right there at age 6.
Yes, but it's not just the hustle. It's the strict adherence to his own rules. He also sold chewing gum door to door. And if a neighbor only wanted one piece of gum, 6-year-old Warren would refuse to split the pack.
Wait, even if the neighbor was practically begging him, like, come on, kid, just give me one piece.
Yes, because he understood unit margins. He knew intuitively that if he broke the pack, he'd be left with unsold inventory, 4 sticks of gum that nobody else might want, and his exact unit margin would be destroyed.
That's wild.
To have the discipline to walk away from a bad deal at age 7 because it violates your internal business logic, that is the inner scorecard in action.
It's incredibly revealing, and he escalates this rapidly, doesn't it?
Oh, yeah.
By his early teens, he's running a used golf ball business. He buys them for $3.50 a dozen from a supplier in Chicago, and then he sells them for $6 at the local Elmwood Park course.
Pure arbitrage.
And he's putting pinball machines in barbershops, too. He understood that the capital expenditure of the machine is quickly outweighed by the recurring passive cash flow it generates while he's just sitting at a desk at school.
He was a business owner before he was a high school graduate.
Oh, absolutely.
Yeah.
By age 14, he is filing his first tax return, and he claims a $35 deduction for the use of his bicycle and watch on his paper route.
And we really have to look at the mechanics of his farm purchase, too. When he was 14, he bought a 40-acre farm in Nebraska for $1,200.
14 years old, buying a 40-acre farm.
Right. And he didn't farm it himself. He leased it to a tenant farmer. He was analyzing real asset investment, lease-based cash flow, and tax depreciation before he could legally drive a car.
That's insane.
By the time he was 16, he had amassed the equivalent of $53,000 in today's dollars.
But, you know, this makes him sound like a flawless prodigy. And that's exactly the myth we're trying to dismantle today. Because when he makes his first actual stock market investment, it is a complete psychological disaster.
Oh, yes. It shows exactly what happens when the inner scorecard cracks.
The city's service-preferred story. It's the crucible that defined his rules of investing. Let's set the stage for you listening. It's 1942, right after Pearl Harbor.
A very tense time.
The macro environment is terrifying, the market is down, and an 11-year-old Warren pools his money with his older sister, Doris. They buy 3 shares of City's Service Preferred at $38.25 share. And almost immediately, the stock plunges to $27.
A nearly 30% drop. Now imagine being an 11-year-old. You've been saving nickels from selling gum for 5 years.
5 years of door-to-door walking.
That money represents hundreds of hours of labor.
Yeah.
And worse, you've dragged your sister into it.
And Doris has to walk to school with him every single day. She is apparently nagging him constantly about the dropping price. The emotional pressure on him is immense. He feels terribly responsible for her capital.
And that external pressure, her anxiety, pollutes his decision-making. The stock eventually claws its way back up to $40.
Thank goodness.
Right. But Warren, exhausted by the stress, impatient, and desperately wanting to just get Doris off his back, sells the 3 shares. He makes a tiny profit of maybe $5 after commissions.
And then, shortly after, the stock shoots up to $200 a share.
$200 is agonizing. But from this deeply emotional failure, he extracts 3 mechanical, lifelong lessons.
What are they?
First, do not fixate on the price you paid for stock. The market does not care what your cost basis is. It only cares about the underlying value of the business moving forward.
Right. And second, don't rush to grab a small profit just to relieve emotional discomfort.
Right.
That was pure anxiety dictating a trade, not logic.
Exactly. He just wanted the pain to stop. And the third lesson is the most critical for the architecture of Berkshire Hathaway later on. Never invest other people's money if their emotional volatility is going to compromise your judgment.
Wow.
He learned that his inner scorecard was shattered by his sister's outer anxiety. He let her fear dictate his execution.
He realizes he needs a fortress against that kind of emotion.
Yeah.
He has the hustle, he has the psychological foundation taking shape, but he needs a rigorous intellectual toolkit to pair with it.
He needs rules.
Which brings up a fascinating debate. Was their ultimate success a product of their raw intelligence, or their stubborn refusal to accept the rules everyone else played by?
It's a mix, obviously, but leaning heavily toward the latter. Because the path he took was basically shaped by rejection. His father forced him to go to college. He went to Wharton, found it entirely too theoretical. They were teaching broader economic theory, not how to actually value a business. So he transferred and finished at the University of Nebraska.
And then he applies to Harvard Business School.
And Harvard rejects him. The admissions officer literally tells him he's too young and doesn't have the right profile.
Which is, honestly, the greatest stroke of luck in financial history.
Oh, completely. Because after getting rejected by Harvard, he's flipping through a college catalog and realizes that Benjamin Graham is a professor at Columbia University.
Ah, Benjamin Graham.
Graham had recently published The Intelligent Investor, a book that Warren had read and practically memorized.
We really need to pause on Benjamin Graham, because before Graham, the stock market in the 1920s and 30s was basically a casino. It was built on tips, rumors, and charts.
It is gambling.
Pure gambling. Graham came in and said, no, these are fractional ownerships of actual living businesses. We can measure them mathematically.
Graham provided a rigorous, quantitative framework born out of the trauma of the Great Depression. He wanted to find a way to invest that protected capital above all else.
Right.
And to translate his philosophy to his students, Graham invented a brilliant cinematic metaphor. He told them to imagine they had a business partner named Mr. Market.
I love the Mr. Market concept.
Yeah.
It completely changes how you view a ticker symbol on a screen.
It really does. Graham described Mr. Market as a manic, depressive, highly emotional business partner who knocks on your door every single day, shouting out a different price at which he will either buy your half of the business or sell you his half. Some days, Mr. Market is euphoric. He sees only blue skies, infinite growth, and he demands an outrageously high price for his shares.
And then other days, Mr. Market is utterly despondent. He reads a bad headline, he's terrified of a recession, and he offers to sell you his half for pennies on the dollar just to get out.
And the genius of Graham's concept is that it flips the power dynamic. Most investors let the stock market instruct them.
Like, if the price drops, they freak out.
Right. If the price of a stock goes down, they assume the market knows something they don't, and they panic and sell. Graham said, no, Mr. Market is your servant, not your master. Mr. Market is there to serve you with opportunities.
You don't have to agree with his price.
You simply wait for him to have a depressive episode, and then you buy his assets for cheap.
It completely neutralizes the emotional volatility. It gives you permission to just ignore the noise. But Graham had a very specific, almost brutal way of exploiting Mr. Market's mood swings. It was called cigar butt investing.
Yes, deep value quantitative investing. The cigar butt analogy is crude but perfect. Imagine walking down the street and seeing a discarded, soggy cigar butt on the sidewalk.
Yuck.
It's disgusting. The business has no long-term future, but it has exactly one free puff left in it. Graham's strategy was to scour the market for companies that were so cheap, so beaten down, that they were trading for less than their networking capital.
Let's define that mechanically for the listener. He's looking at the balance sheet. He's ignoring the factories, the machinery, the brand name, because those are hard to value or liquidate.
Right. Ignore the hard assets.
He is strictly looking at cash, receivables, and inventory, minus all the total liabilities.
Yeah.
If a company has $10 million in cash and easy-to-sell inventory and only $5 million in total debt, the absolute floor of its value is $5 million.
Exactly. It's called net current asset value. And Graham would find companies where that math checked out at $5 million. But Mr. Market was in a depressed panic and pricing the entire company on the stock exchange at, say, $3 million.
So you buy it at $3 million. Even if the business goes bankrupt and liquidates the next day, you literally get paid $5 million. It's a mathematically guaranteed profit.
You don't care if it's a terrible business making buggy whips. You just care that the liquid assets are worth more than the stock price. And Graham paired this with his golden rule, the margin of safety.
The margin of safety. The way I've always translated it is through an engineering lens. It's like building a bridge.
Okay, let's hear it.
If you're an engineer and you know you need a bridge to hold 10,000-pound trucks, you do not design a bridge that holds exactly 10,001 pounds.
No, that would be a disaster waiting to happen.
Exactly. You build a bridge designed to hold 30,000 pounds. That gap, that 20,000 pounds of breathing room, is your margin of safety.
That's a perfect analogy. But let's take that bridge analogy a step further to expose the flaw that Buffett eventually ran into. What if you build that bridge capable of holding 30,000 pounds, but the materials you bought at a steep discount are secretly rotting? Or what if you build it in a town where the population is leaving and eventually no trucks drive over it at all?
Ah, right. The margin of safety protects your initial capital, but it doesn't guarantee future growth if the underlying asset is fundamentally decaying.
Exactly. Graham was scarred by the Depression, so his entire philosophy was defensive. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He just wanted to protect the downside.
Protect the downside at all costs.
So Buffett graduates, he pesters Graham until he finally hires him at his investment firm. And Warren spends a few years mastering this exact cigar butt strategy. He is running a Geiger counter over the detritus of Wall Street.
Buying mediocre, dying companies at bargain basement prices, getting that one free puff of profit, and moving on. And he is incredibly successful at it, too. He takes his personal capital from $10,000 to over $100,000 in a very short time.
But this is where the story takes a massive, dramatic turn. Because this exact strategy, the very foundation of his early success, the Graham rulebook leads him straight into the abyss.
Here's where it gets really interesting, because it leads him to what he openly admits is his dumbest stock purchase ever, and it involves a dying textile mill in New England called Berkshire Hathaway.
It is the ultimate irony that the crown jewel of global capitalism, a $900 billion conglomerate today, started as a catastrophic, emotionally driven mistake.
We really need to dig into the mechanics of this blunder. It's the 1960s. The New England textile industry is dying. The mills are moving to the American South for cheaper labor and increasingly overseas. Berkshire Hathaway is a classic, soggy cigar butt.
Right. Buffett started buying shares of Berkshire purely based on a mathematical pattern he observed. The company was shrinking. They would close a textile mill, sell off the equipment, free up some capital, and then use that cash to buy back their own shares in the market to prop up the price.
So Buffett's plan is super simple. Buy the stock cheap, wait for the next inevitable mill closure and subsequent share buyback, tender his shares back to the management at a premium, get his one free puff, and walk away forever.
That was the plan. So in 1964, Buffett strikes a verbal deal with the president of the textile mill, a man named Seabury Stanton.
Okay.
Stanton asks Buffett at what price he would be willing to tender his shares back to the company. Buffett says $11.50 a share. Stanton verbally agrees. A nice, clean, profitable exit for Buffett.
But then the official written tender offer arrives in the mail a few weeks later, and the price on the document isn't $11.50. It is $11.37.5.
Seabury Stanton shortchanged him by an eighth of a point, by 12.5 cents.
Now, wait a minute. Buffett is a guy who champions rationality. He preaches the inner scorecard. He knows it's a terrible business. Why not just take the $11.37, make your profit, and move on to a better investment? Why let a dime ruin the trade?
Because the slight stung his ego. He felt he was being played for a fool by a dying management team. In that moment, he experienced a complete psychological break from the Graham framework.
And he just snapped.
He completely abandoned his inner scorecard and reacted purely out of spite. Instead of selling his shares and walking away, he decided to buy more shares.
He aggressively bought up a controlling stake in the entire company just so he could fire Seabury Stanton.
Yes.
He literally bought a dying textile mill out of petty revenge. It's an incredible contradiction. I mean, he despised Wall Street egos, yet he destroyed a company's leadership over 12.5 cents.
And the economic consequence of that revenge was catastrophic. By taking control of Berkshire Hathaway, he found himself anchored to a fundamentally horrific business model.
How bad was it?
Well, we need to look at the mechanics of the textile industry at that time. It was incredibly capital intensive. You had to constantly buy new, expensive looms and machinery just to stay competitive with foreign manufacturers.
Right, the tech was always evolving.
But because commodities like textiles have no pricing power, I mean, a sheet is a sheet, they couldn't raise prices to cover the cost of the new machines.
So every single dollar the business generated had to be immediately plowed right back into the factory just to tread water. There's zero free cash flow. He couldn't just take his one puff and throw it away anymore. He owned the whole cigar, and it was burning his hand.
He fought that failing textile business for 20 years.
20 years.
He kept trying to improve operations, pouring good money after bad, trying to save the jobs in New Bedford, Massachusetts, before finally throwing in the towel and shutting down the last mills in 1985.
He wasted 2 decades fighting terrible economics.
Wow.
And the math on his opportunity cost is staggering. He later calculated that if he had just taken the money he poured into those dying textile mills and invested it directly into the insurance businesses he eventually bought, the compound interest over those decades would have amounted to roughly $200 billion.
It is the most expensive temper tantrum in financial history.
Unbelievable.
But psychologically, it was the exact crucible he needed. This failure forced him to evolve. He realized the fatal flaw in Benjamin Graham's strategy. Cigar butts do not scale.
Expand on that. Why doesn't a cigar butt scale? If you have more money, just buy more cheap companies.
It doesn't work mechanically.
Yeah.
When you have $100,000, you can find tiny, forgotten companies trading below liquidation value. But when you have $10 million or $100 million, those tiny companies aren't big enough to absorb your capital.
Oh, I see.
If you try to buy larger companies at a discount, you end up buying massive, deeply troubled businesses with entrenched structural problems like a giant failing textile mill.
So you're just buying giant headaches.
Exactly.
Furthermore,
Furthermore, cigar butt investing requires constant turnover. You buy, you get the puff, you sell, you pay taxes on the gain, and then you have to go hunt for another rare bargain.
the transaction costs alone.
It's exhausting, and the tax friction destroys long-term compounding.
This is the turning point. This is the exact aha moment where his unique philosophy clicked. He realizes that to build a lasting empire, he has to completely abandon the rules that made him his first million. He has to break Graham's rules.
And he didn't do it alone. This evolution was heavily driven by his longtime partner, Charlie Munger, and the writings of another investor named Phil Fisher.
Right.
Munger notoriously pointed out that Warren was suffering from fuzzy thinking by clinging so tightly to Graham's bargain hunting methods. Munger told him point blank, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price."
It sounds like a simple bumper sticker, but mechanically, it's a profound shift in capital allocation.
Yeah.
Stop looking for cheap garbage that you have to sell in a year. Start looking for high-quality royalty that you can hold forever.
Yes.
And the defining metric for this new philosophy, the jargon we need to translate for you guys listening, is the moat.
The economic moat. This becomes the defining filter for Berkshire Hathaway.
So imagine a beautiful, highly profitable castle. That castle's a wonderful business throwing off cash. But in capitalism, if you have a profitable castle, competitors are immediately going to build a castle right next door, drop their prices, storm your castle, and take your gold.
That's just the free market at work.
Exactly. A moat is a sustainable competitive advantage. It's what keeps the invaders out. It could be brand loyalty, being the lowest cost producer, or having high switching costs for your customers. A deep moat allows the castle to just keep generating wealth without constantly having to spend money to defend itself.
And the absolute proof of concept for this shift was their 1972 purchase of See's Candies. See's was the complete opposite of a cigar butt.
Wait, I want to challenge this because I've looked at the math of the See's Candies deal, and from a strict Ben Graham perspective, it looks insane.
It does.
See's was making about $4 million a year in pre-tax profit, and it only had $8 million in net tangible assets. Yet the sellers wanted $30 million to the company. Eventually, they settled on $25 million. Paying $25 million for $8 million in hard assets violates every single rule Ben Graham ever wrote. How did Munger convince him to pay a premium for a candy shop?
By making him look at the intangible assets, the moat in the minds of the consumers. See's Candies had an absolute monopoly on Valentine's Day and Christmas in California.
Right, everyone bought it.
People loved the brand so much and associated it so deeply with romance and quality that See's could raise the price of a box of chocolates every single year and people would still buy it.
They wouldn't even blink.
You don't bargain hunt for a box of chocolates for your wife on Valentine's Day. You buy the premium box. That is pricing power.
And pricing power is the ultimate defense against inflation.
Exactly. Remember the textile mill. Inflation destroyed the mill because they couldn't raise the price of sheets, but the cost of looms kept rising. See's Candies required almost zero capital expenditure.
Oh, because they didn't need to constantly upgrade their candy-making machines.
Right. So as they raised prices every year, all of that extra revenue dropped straight to the bottom line as pure free cash flow. Over the next few decades, See's generated over $2 billion in pre-tax income for Berkshire, requiring barely any additional capital injection.
That is the magic of an inflationary moat. The business grows in profitability without consuming its own cash.
It's beautiful.
But wait, if he is pivoting to buying these wonderful companies, he needs capital, a lot of it. And this brings us to the actual mechanical secret weapon of Warren Buffett. How did he get the billions of dollars required to buy massive companies like Coca-Cola or the Washington Post?
He needed a fountain of money.
We need to translate another crucial piece of financial mechanics, the float.
The float is the beating heart of Berkshire Hathaway, and it stems from his realization that he could use insurance companies, specifically companies like National Indemnity, Geico, and later General Re, as massive, unregulated capital generators.
Let's break down the logistics of insurance. Think about a magazine subscription. You pay for a whole year up front, say $120. The magazine publisher gets your money today, but they only have to deliver a $10 magazine to you once a month. They get to hold on to the bulk of your money for months before providing the service.
Insurance works on that exact principle, but on a massive scale. You pay your auto insurance premium to Geico today. Geico might not have to pay out a claim to you for years, maybe decades, or maybe never at all.
Hopefully never.
Right. That pool of collected premiums that hasn't been paid out in claims yet is called float. It sits on the balance sheet as a liability because technically the insurance company owes it back eventually, but in reality it functions as a revolving fund.
It is essentially free money. It's a loan from the customers. If I want to buy a stock, I have to go to a bank, take out a margin loan, and pay 8% interest. And if the stock goes down, the bank margin calls me and I'm wiped out.
You lose everything.
But Buffett took billions of dollars of float and used it to buy stocks. He had an ever-growing source of leverage that cost him nothing.
Actually, it's better than nothing. You have to look at the combined ratio of his insurance companies. If an insurance company takes in $100 in premiums and pays out $95 in claims and expenses, their combined ratio is 95. They made a 5% underwriting profit.
Okay,
So not only is Buffett getting billions of dollars of float to invest, he is literally being paid 5% to hold that money. It's negative cost capital.
But I need to ask, why doesn't every insurance company do this? Why isn't State Farm buying up whole companies like Dairy Queen or massive chunks of Apple stock?
Because of regulatory constraints and the fundamental risk of equity markets. Most insurance companies are required by regulators to invest their float in highly liquid, incredibly safe assets, mostly government bonds and highly rated corporate debt.
Right, because if an earthquake hits California and an insurer suddenly needs to pay out $5 billion in claims, they can't be caught holding illiquid businesses or stocks that might have crashed that same week.
They need cash immediately.
So how does Berkshire get away with it?
Because Berkshire Hathaway has a massive separate pool of equity capital generated by its non-insurance businesses, the candy companies, the furniture stores, the energy utilities, regulators look at Berkshire and see a fortress of cash and diverse earnings. Because Berkshire is so overcapitalized, regulators allow their insurance subsidiaries to invest a much larger portion of their float into equities. Buffett effectively built a structural advantage that cannot be replicated by a pure-play insurance company.
It is a breathtakingly elegant system. He uses the cash from the candy store to satisfy the insurance regulators, which allows him to use the insurance float to buy more businesses, which generates more cash. It's an unstoppable compounding loop.
The ultimate snowball.
But there is a massive vulnerability here. This entire system requires one thing above all else to work: absolute unimpeachable trust.
Yes, because if people don't trust you, they don't buy your insurance policies. If regulators don't trust you, they force you to hold more capital in restrictive bonds, and the float engine stalls completely.
Which brings us to a terrifying scenario. What do you do when your absolute certainty, your carefully constructed ethical fortress, is met with catastrophic market failure? We are entering the abyss, part 2.
The Salomon Brothers crisis of 1991. This is the ultimate existential test of the inner scorecard.
Let me set the stage. It's August 1991. Berkshire Hathaway has used its capital to buy a 12% stake in Salomon Brothers, a legendary Wall Street investment bank. Now, wait a minute, I have to pause here. Buffett and Munger famously despised investment bankers.
Good, they hated them.
They spent decades mocking the greed, the short-term thinking, the outrageous bonuses of Wall Street. So why on earth did he partner with an investment bank he claimed to despise? Isn't that deeply hypocritical?
It was a miscalculation based on the allure of a very attractive financial instrument. He didn't buy common stock. He bought convertible preferred stock that paid a very high 9% dividend, while also giving him the upside if the stock price rose.
Okay, so the terms are just too good.
Right. He acted as a white knight to help Salomon fend off a hostile takeover. He thought he was being a shrewd financier, locking in a high yield, but he completely underestimated the toxicity of the culture he was legally binding himself to.
And that toxicity explodes. A rogue trader at Salmon, a man named Paul Moser, had figured out a way to scam the U.S. Treasury bond auctions.
The Treasury auction is the bedrock of the global financial system. The U.S. government issues debt, and banks bid on it. To prevent any one bank from cornering the market and manipulating interest rates, the Treasury had a strict rule. No single firm could bid for more than 35% of a given bond issue.
Paul Moser decided that rule didn't apply to him.
No, he did not.
He was illegally submitting massive, unauthorized bids for government bonds using the names of Salomon's clients who had absolutely no idea what was happening. In one auction, he managed to corner over 85% of the 2-year Treasury notes. He squeezed the market, making huge profits for Salomon while crushing other trading firms who had shorted the bonds.
And when the U.S. government finds out, they are furious. Wall Street was already scarred by the insider trading scandals of the 1980s, the Michael Milken, Ivan Boesky era. The Treasury Department, the Federal Reserve, the SEC, the Justice Department, they all descend on Salomon Brothers with a vengeance.
Stakes are apocalyptic. Salomon is highly leveraged. They owed roughly $150 billion. If the government suspended them from bidding in the Treasury auctions, other banks would instantly stop trading with them. They would be bankrupted in hours.
It would be a catastrophic shock to the entire global financial system.
The top executives at Salomon, who had known about the false bids for months but failed to report them, are forced to resign in disgrace on a Sunday morning.
The firm is leaderless and has literally hours before the Federal Reserve of New York pulls the plug.
Into this raging inferno steps Warren Buffett. The guy from Omaha, who hates investment banks, is suddenly appointed interim chairman and CEO of the biggest, most aggressive trading floor in the world.
He has to save the firm to save his own $700 million investment, but more importantly, he has to save his reputation.
How exactly does he do it? Because he doesn't hire a crisis PR firm. He doesn't use Wall Street spin.
What's fascinating here is he relies entirely on his inner scorecard. He goes directly to the Treasury Secretary, Nicholas Brady. Buffett essentially says, I am taking over. We are opening our books. Radical transparency, no more secrets. We will waive attorney-client privilege. You can see everything.
He put his own immaculate lifetime reputation on the line to vouch for a firm that was deeply corrupt.
He risked everything. If the Justice Department found out the rot was deeper than Moser, Buffett's reputation, the very thing his insurance empire was built on, would be destroyed.
And he didn't just appease the government. He had to change the culture overnight. He calls a congressional hearing, and he delivers one of the most legendary speeches in corporate history.
Oh, this speech is incredible.
He looks into the cameras, addressing the Salomon employees, and says, I have asked every Salomon employee to be his or her own compliance officer. After they first obey all rules, I then want employees to ask themselves whether they are willing to have any contemplated act appear the next day on the front page of their local paper.
Yeah.
If they follow this test, they need not fear my other message to them. Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless.
I will be ruthless. It gives you chills because what he is doing there isn't preaching morality for the sake of being a good person. He is proving that ethics is a mechanical risk management tool.
Right?
In a complex, highly leveraged financial system where you rely on counterparty trust, unethical behavior is an existential financial risk. His reputation, his inner scorecard, literally saved Salomon from bankruptcy. The Treasury granted them a stay of execution purely because they believed Warren Buffett would clean up the mess.
It's an incredible climax to his professional evolution.
Sure.
From the kid selling gum to the man staring down the U.S. Treasury to save the financial system, the stress of that period was reportedly so intense that it fundamentally reinforced his desire for simplicity.
Oh, absolutely. He retreated to his habits.
Because behind all of this massive, earth-shaking finance is a guy who lives a remarkably strange, simple life. The hidden quirks, the daily architecture of the Oracle.
Yes, the daily habits that humanize him, but also practically shield his cognitive bandwidth. We have to understand how he manages the informational load of running a conglomerate of that size.
Right, because if you ask someone what a billionaire CEO does all day, they picture a guy screaming into 2 cell phones, running between private jets, surrounded by monitors flashing red and green numbers, constantly reacting to news alerts.
That's the movie version.
But Buffett. The sources detail that he spends roughly 80% of his day, 5 to 6 hours, just sitting quietly in an office in Omaha, reading.
He consumes an astonishing information diet. up to 500 pages a day, 3 newspapers every morning, the Financial Times, the New York Times, and the Wall Street Journal. He reads trade journals, biographies, but the vast majority of his time is spent reading raw corporate annual reports, the 10Ks.
And he doesn't just skim the executive summaries. He is famous for dissecting the footnotes.
Can you explain why the footnotes matter so much? Most investors just look at the top-line earnings.
Because the top-line earnings are often massaged by accountants.
Right.
The real mechanics of the business are buried in the back. Buffett looks at the footnotes to understand a company's deferred tax liabilities, their pension obligations, which can be a ticking time bomb, and their inventory accounting methods.
Give me an example. Well, if a company is suddenly switching from LIFO, which is last in, first out, to FIFO, first in, first out inventory accounting during a period of inflation, Buffett knows they are likely trying to artificially inflate the reported earnings to mask underlying weakness. He builds a comprehensive mathematical understanding of entire industries just by reading their public filings for decades.
He once said that knowledge builds up like compound interest. But to protect that reading time, his lifestyle has to be relentlessly simple. The frugality is famous. He lives in the exact same stucco house in Omaha that he bought in 1958 for $31,500. He drives his own Cadillac. He didn't even have a computer on his desk for decades.
And his diet is equally regimented. He eats like a 6-year-old. Hamburgers, hash browns, and he famously drinks 5 cans of cherry Coke a day.
Let's actually talk about Coca-Cola, because it wasn't just a quirky beverage choice. It was one of his greatest investments. He didn't just wake up one day and buy it because he liked the taste.
Right. He bought roughly $1 billion of Coca-Cola stock in 1988, shortly after the devastating 1987 Black Monday stock market crash. Wall Street thought he was crazy. Coke wasn't a cheap cigar butt. It was trading at a relatively high price-to-earnings ratio of around 15.
So why did he buy it? How did the math work?
He saw what Wall Street missed: international margin expansion. He had read decades of Coke's annual reports. He saw that under their new CEO, Roberto Goizueta, Coke was aggressively expanding overseas. More importantly, he understood the fundamental economics of syrup.
Syrup.
Yeah, Coca-Cola doesn't bottle drinks, they sell the syrup to bottlers. Making syrup requires almost zero capital expenditure. It's incredibly cheap. So as international volume exploded, the revenue grew exponentially while the capital costs stayed flat. It was the ultimate toll bridge business, protected by a 100-year-old brand moat.
He saw the compounding cash flow hidden in plain sight, and his daily routine is designed specifically to allow him to spot these rare anomalies. In an era where modern finance glorifies the grueling hustle culture, working 90-hour weeks, sending emails at 3 a.m., Buffett openly rejects it.
He really does.
He gets into the office at 8:30 a.m. and leaves at 5:30 p.m. sharp. He spends hours playing online bridge to exercise his probabilistic thinking. He aggressively guards his calendar against unnecessary meetings. He even renamed his private jet from the indefensible to the indispensable.
This raises an essential analytical question. Is this routine just the luxury of an old rich man, or is this aggressive simplicity the actual mechanical secret to his genius?
I honestly think it's the secret.
Yeah.
By eliminating decision fatigue, living in the same house, eating the same food, working the same hours, staying in Omaha far away from the herd mentality of Manhattan, he frees up 100% of his cognitive bandwidth for the only thing that matters: capital allocation.
He often references Ted Williams, the legendary baseball player.
Oh, yeah, the batting average guy.
Williams wrote a book called The Science of Hitting, where he mathematically divided the strike zone into 77 distinct segments. He realized that if he only swung at pitches in his absolute happy zone, the sweet spot, he would bat .4 under. But if he reached for pitches on the lower outside corner, his average would drop to .230.
And the beauty of the stock market, as Buffett points out, is that there are no called strikes. You can stand at the plate and watch 10,000 companies go by.
And you don't lose anything.
Exactly. The crowd can be screaming at you to swing at internet stocks in 1999. They can call you out of touch. But you don't suffer a penalty for waiting. You just sit in your office in Omaha, read your 10Ks, drink a cherry Coke, and wait perfectly still until a business with a massive moat, incredible management, and a discounted price crosses exactly into your sweet spot. Then you swing heavy.
It is the ultimate manifestation of the inner scorecard. He doesn't care if the crowd is booing him for not swinging. He judges his performance entirely by his own metric of value.
Which leads us to the end game, the final conquest. When you have solved the market, when you have built a near trillion-dollar conglomerate, when you have amassed over $140 billion, what is actually left to conquer?
Legacy, and a radical restructuring of what it means to deploy capital at the end of your life.
Because he isn't dying with his money. He made a massive pivot. For decades, he was criticized for being a hoarder. He didn't give much to charity early in his career. Why was that?
Because he understood the mathematical power of compounding better than anyone on Earth. He knew that a dollar given away to a hospital in 1970 was essentially robbing that hospital of the thousands of dollars that single dollar could compound into if he invested it until 2010.
So he felt it was a disservice to give it away too early.
Exactly. He believed he was the best compounder of capital alive, so the most ethical thing he could do was hold the money, grow it to an unfathomable size, and then give the massive snowball away at the end.
And he is giving 99% of it away, primarily to the Bill and Melinda Gates Foundation and to foundations run by his family. And his philosophy on dynastic wealth is fascinating. He's leaving his kids a relatively minuscule amount, roughly $5 million each.
Which is still a lot, but peanuts compared to his net worth.
Right. He famously said he wants to leave them enough to do anything, but not enough to do nothing. He genuinely believes that inherited financial dynasties are toxic to a functioning meritocracy.
But if we look closely, his legacy isn't just the sheer tonnage of money he's giving away, it's the pedagogy. His greatest legacy might actually be his annual shareholder letters.
Oh, absolutely. They're essentially a free MBA program. He writes them himself, ignoring corporate PR speak, using a folksy, highly accessible style to explain complex macroeconomic concepts.
He functions primarily as a teacher.
And what's most radical about these letters is how openly he dissects his own failures.
He embraces his mistakes with brutal transparency. In the letters, he wrote extensively about his disastrous purchase of Dexter's shoe in 1993. He didn't just buy a bad shoe company. He paid for it using Berkshire Hathaway stock instead of cash.
Ouch.
Yeah. As the shoe business collapsed against foreign competition, the Berkshire shares he gave away continued to compound. He calculated that this single mistake cost his shareholders billions of dollars.
He also wrote about the UK grocer Tesco, where he admitted to dawdling on selling his shares as the company's accounting scandals unfolded, costing him $444 million. He called his failure to invest in Amazon and Google, despite acknowledging their brilliant models, a huge, thumb-sucking error.
By analyzing his own flaws in public, he demystifies the aura of the Oracle. He proves to retail investors that you do not have to be infallible to be wildly successful. You just have to be rational, learn from your structural errors, and stay rigorously within what he calls your circle of competence. Meaning if you don't understand how a tech company makes money, you simply don't buy it, no matter how much the stock is soaring.
And this pedagogical culture, this deep commitment to rationality, extreme trust, and decentralized management is what he hopes will survive him. He's preparing to transition power to Greg Abel, who currently oversees Berkshire's non-insurance operations.
The transition plan isn't about finding a new stock picker. Berkshire has a massive portfolio of wholly owned operating companies, railroads, energy grids, manufacturing. Abel's mandate isn't to be the next Warren Buffett. His mandate is to uphold the culture.
To keep the machine running.
Right. To be the steward of the inner scorecard for the next generation, ensuring that the managers of those subsidiary companies continue to operate with the same long-term horizon and ethical baseline.
So what does this all mean? We've journeyed from a 6-year-old kid refusing to split a pack of gum to protect his unit margin to an 11-year-old agonizing over his sister's panic during a market drop. We saw him learn the mathematical detachment of Mr. Market from Ben Graham, only to fall into the abyss of revenge with the Berkshire textile mill.
A lot of ups and downs.
We watched him pivot, with Charlie Munger's help, to buying wonderful companies with impenetrable inflation-resistant moats. And we saw him stare down the Federal Reserve to save a rogue Wall Street bank with nothing but the sheer force of his own reputation.
It is a profound arc. And every single triumph and failure traces back to that one core psychological framework introduced by his father when he was just a boy.
The inner scorecard. Which leaves us with a final thought to mull over. You don't need $1 billion or a mastery of float mechanics to build an inner scorecard. We live in a world that is hyper-obsessed with external validation. We are constantly pressured by social media metrics, keeping up with the neighbors, the relentless anxiety of the outer scorecard.
But if you study the architecture of this phenomenal success, the question becomes, what would happen to your life, your career, and your peace of mind if you completely threw away the world's balance sheet? What if you only judged your success by the metrics you set for yourself?
Are you painting your Sistine Chapel for the applause, or are you painting it because it's exactly the way you know it should look? Thank you so much for joining us on this deep dive. It's been an incredible journey unpacking the complex, intensely human machinery behind the Oracle. We'll be back next time with another deep dive into the forces that shape our world. Until then, keep reading the footnotes, wait for your perfect pitch, and always trust your own scorecard.